Welcome to the May edition of From the Desk of Gordon Haave. I'm Gordon Haave, and it's good to see you again. Now, today we're just going to jump right into it. The market's been down. Let's take a look at why that's happening. It all starts with inflation. Here's what happens. Inflation causes the Fed to raise rates. Investors fear that rising rates will cause a recession and a resultant earnings decline, so investors sell stocks, causing the price to earnings ratio to decline. See, earnings are still strong, but investors anticipate that they're going to go down in the future. So the price to earnings ratio is declining. To take a look at that, look at this graph. In red is the S&P 500 price to earnings ratio. It's down. Now, history shows that investors often start to cut the PE multiple just before recessions, and they certainly cut it as recessions unfold. But sometimes they're wrong. Sometimes investors anticipate a recession that doesn't happen. That is, earnings remain strong. When that happens, price to earnings multiples in the stock market tend to rebound. And we see that investors are often wrong. During the course of the latest bull market, there have been over 6 times, or I think exactly 6 times, that the market's been down 10 to 20% because investors anticipated a recession that didn't come to happen. Now, so that leads to the question, what is the state of the economy and where is it going? Well, looking at the numbers, the economy remains strong. In blue is leading economic indicators, in gray is coincident economic indicators, and they're both very strong. We can look at a number of other metrics, all right? Employment payroll remains strong, and we're back near pre-pandemic payroll numbers. Meanwhile, lower income earners in the red and black lines are seeing increasing wages due to labor shortages, and as a result, we see things like this graph where the percentage of low-income earners reporting that next month's rent will be late is plummeting very quickly. Meanwhile, durable goods orders and consumption remain very strong. And this is a graph I've followed for a long time. This is the 3-month moving average of U.S. building permits. And you see it always is declining leading into the recessions, which is the gray horizontal bars. And building permits remain strong. All right, so back to this slide. This is what's going on. I think the economy's still pretty strong and we're not heading into a recession. But the Fed could still kill it. If the Fed raises interest rates too much, that in and of itself can cause a recession. What's the likelihood of that? Well, I think inflation's peaking. What does that mean? If inflation is peaking, even though the Fed's been pretty tight in raising rates, if inflation's peaking, it means the Fed may stop raising rates as much as everyone's anticipating. Now, why do I think that? I just clipped this article from yesterday. Goldman Sachs is saying there's peak inflation, and the numbers that I look at are saying the same thing. U.S. headline CPI inflation is black, and red is a leading indicator for inflation that I follow, and it's down. We're past our peak. If you look at CPI inflation, again in black, versus the Citibank U.S. Inflation Surprise Index in red, we see strong indications that CPI is peaking and is about to start heading down. We certainly see that in the shelter portion of CPI. In black, it tends to follow the inverse of U.S. mortgage spreads. Mortgage rates are rising. The shelter portion of CPI should start coming down. You can also look at this, the Case-Shiller Housing Price Index in black year over year versus an indicator in red, a home price leading indicator that I follow, showing that Case-Shiller housing prices year over year should start declining. And now everyone's talking about supply chain pressures. Well, believe it or not, supply chain pressures are starting to ease. They were actually starting to ease a couple months ago, but the Russian war changed that, but we're seeing them start to ease again, all right? The global supply chain pressure index in red is down, and CPI ought to follow that down. Wages, talked about wages being up. That's great for workers, bad for small businessmen, but we're starting to see that wage growth, it's remaining high, but that's starting to come back also. The wage growth tracker in black tends to follow the Federation of Independent Businesses survey on jobs being hard to fill, and that's coming down. So let's recap. The economy's still strong, and inflation has likely peaked, meaning the Fed is unlikely to raise rates in of itself, killing the economy. So what does that mean for you and your portfolios? Well, we're still in a high inflation environment, and at least as far as stocks go, dividends are a good place to be. See, large companies, or any company, but large companies, they make products. Now, they're seeing their input costs go way up because of inflation. But as long as they're able to raise prices and pass those costs on, the companies are doing okay. And dividend-paying companies, as long as they're able to pass on costs, they're able to keep or increase their dividends. And that's what we're seeing. We're seeing the large dividend-paying companies have been able to increase prices and pass on their costs and keep or raise their dividends. Commodities are also a great place to be. Now, those of you who have watched this video series, I've done a number of long presentations on the commodities super cycle. If you've not seen that, talk to your advisor and you can watch an old video on it. But in short, commodities prices are up, but supply has barely increased. Companies are not increasing research and development and capital expenditures. What does that mean? Prices are likely to stay high for a while. Now, those of you invested in commodities know they move. All right, the first 6 months of last year was very strong for commodity stocks. Then it dipped. Then it was strong again. Now we're in a little bit of a dip. But the commodity super cycle is going to be a multi-year cycle, and the outlook remains strong. Now, everybody always wants to talk about bonds, so let's talk about them. Usually people talk about them negatively. A year ago, it's why should I be in bonds? Rates are so low. Now it's why should I be in bonds? Rates are rising, all right? There's a strong argument to keep or maintain a good allocation in bonds, especially for those of you who are in or near retirement. Now, why do we invest in bonds at all? Why aren't you 100% in stocks, even in retirement? The reality is, as you know, there's a trade-off. It's a risk versus reward. Stocks give you more reward over time than bonds, but they're riskier. So the question, what we want to look at is, when you look at that risk reward between stocks and bonds, what does it look like now that we're in a rising rate environment? Let's take a look. The chart you're looking at shows the Fed funds rate since 1954, highlighting rate hiking cycles. Now on the next slide, I'm going to show you asset class returns for the entire period by whether it's a hiking or easing cycle. Now, except for commodities, all asset classes appear to do worse during hiking cycles. But the gap between stock and bond returns is significantly smaller when the Fed is hiking. That is, the risk reward of stocks versus bonds tilts more favorably towards bonds during hiking cycles. Now, when most of you think about inflation and rising rates, we're usually looking at the period of, say, 1970 to 1982. So we're going to laser focus on just those years in this slide that's on your screen now. During the 59% of the months that the Fed was hiking, equity returns were negative and bond returns were actually positive. So bonds were actually a better inflation hedge than stocks were during hiking portions from 1970 to 1982. Now, the point of this is not that fixed income will outperform equities or that we will repeat the 1970s. The point is that in hiking environments, the risk reward of owning bonds compared to stocks actually improves. And there's a lot of indications that interest rates and bonds might have peaked here. If you look at this graph, the 10-year bond yield has tended to trade closely to the copper to gold price ratio. All right. They've peaked, 10-year yields have peaked above the copper gold price ratio, indicating that they might be a little too high. It might be coming down. And we can see the same sort of thing if we look at the 13-week change in the 10-year bond yields, which is in red, versus the Citibank Economic Surprise Index. They usually track pretty well. And it looks like bond yields have peaked. We might be at the peak here in 10-year yields, which means, again, bonds may very well be a good place to be in this hiking rate environment. So, recap. We're likely in a correction and not a recession. There are strong indications that investors are anticipating a recession that may not happen. Inflation is past its peak. Almost every single metric shows inflation has peaked. It's still high, but it's peaked and is likely on its way down. That means, of course, that the Fed's less likely to be aggressive about rate hikes. Now, in this environment, dividend stocks are a good place to be. As we just went over, the risk reward of being in bonds versus stocks actually improves in hiking cycles, and we're still early in the commodities super cycle. Now, the most important thing is contact your advisor. Do you have the right allocation to dividend stocks and commodities? Is your bond allocation too low or maybe even too high? More importantly, during these volatile times, do you have enough income to get you through retirement? These are all questions your advisor can help answer. Thank you, and I'll see you next month.